And good morning again, everybody. Thank you for joining us today for our latest webinar where we're going to be talking about Capital City investment. My name is William Page. I look after the sales team here at IP Global, and I'm joined by Jeremy Marshall, who is our head of Abu Dhabi and been with us for many years. Jeremy, when did you join the business? 2014, I think, wasn't it? 13?
No, it'll be 10 years in about a couple of weeks' time, actually.
Very good, very good. So just to start with, we're going to be having a webinar in 2 weeks about the rental market, a bit of an update about the UK rental market. So please do look out for an invitation for that webinar. It's going to be 2 weeks today, and feel free to drop a message into the group if you'd like us to send you the sign up link. We've also got a questions box as well that you can pop any questions in. Feel free to fill those in, and we'll probably handle those at the end just to keep the presentation flowing. If we just jump to the next slide, please, Mary Carr. So just the agenda, a little bit about IP Global to start with. If you just go back one, Mary Carr, please. So we'll talk a bit about IP Global, just for those of you that don't know us. We'll be looking at the factors that drive investment in capital cities. We'll have a quick look at the top European cities for investment. And then we're going to have a look at what we're doing now, what we're investing in now in capital cities. And I think really why we're holding this webinar is important. I mean, we've been investing in property, obviously, since we were founded back in 2006. And a key focus for us over the years has been capital cities. And, you know, Jeremy and I are often asked, you know, why? You know, it's expensive to buy property in capital cities. Often the yields, the returns that you get on a sort of rental income can be a little bit lower. But they consistently are the top places to invest, and there are a lot of investors buying there for good reason. So we wanted to sort of discuss why that is. And there's a few different factors that we're going to talk about in this webinar about that. So hopefully you find that useful. Right, next slide then, please, Mary Carr. Handing over to Jeremy.
So, yeah, I mean, appreciate there's probably a handful of people on here, or maybe the majority, who do know us quite well. But I think, you know, and might well know our business model and how we operate. But I think it's important to kind of cover that, particularly in context as to why we do so often look at capital cities, really. Because, you know, we are very much a global company with a global reach and outlook. You know, and in our past, we've bought and sold, you know, just north of $3 billion worth of property in many different markets. Well, about over 30 cities in that regard. So, but it's always about essentially where is the best place to invest for the next 10 years in terms of safety and in terms of returns. So, how we operate is normally what you exist in market is you either have a developer, you know, who's bought some land and is based in probably a certain region or certain city, or you have sales agents who are effectively working for that developer, really, and getting paid commissions to sell those properties. Us as an investment company, we work slightly differently, and it's, you know, incredibly rare in the property world. But it's all research led, so we'll then pinpoint where we think globally is the best and safest place to invest in the next 10 years, and then we will underwrite projects. So this means we'll put our own cash down. We will have exclusivity on a project, and we take the liability onto ourselves. We guarantee we're going to be purchasing those on completion if they're not sold to our client base around the world. And then we'll help people with every step in the process, basically, wherever you're based in the world. We'll help people to buy, we'll give them the advice, then we've got the mortgages, we've got the lettings teams on the ground, and we'll be with you effectively for not just the purchase process, but the entire duration of however long you own that property, to keep giving advice, to advise on when the best time is to maybe maximize the profits, maybe hold on to it, maybe sell it, and to keep you educated in the property world and where is looking good now in that regard. And the next slide. So a brief background, you know, as I mentioned, we've bought and sold property in many jurisdictions in the world. You know, this is just a look at the capital cities, which is the focus of our presentation today. We also have Edinburgh and Berlin, which we're going to talk a little bit more about further on. But this gives you an idea basically of, over our 18-year history, the world changes, it migrates in terms of its interest and how markets are doing. And we learn lessons from that, and then we approach and attack markets that serve us best for the next decade to 15 years. And so certainly what we've learned over our time, we did some of these markets like Kuala Lumpur and Sao Paulo and places like that. These are pre-global financial crisis and, very upward looking. But what we found in from that experience is actually a lot of the time we don't need to take that kind of risk with an emerging market. And actually what we've found is we've been honing down now to the more developed markets. So, more recently we did some stuff in Australia and some stuff in the US. But probably in the last 8-9 years, we've very much honed down to the UK. London was our first market there, just in April 2009, just when the market was swinging there. Did enormously successful for a lot of our clients, and then more recently migrated to other cities in the UK as well. So Manchester, Birmingham's, and the secondary markets there. But it's always about the same principles about safe economies and growing economies, and this is essentially what's going to give you a good outlook for your investment horizon.
Yeah, and I think just to add, Jeremy, it's all about buying at the right time, and we were buying in New York sort of just after the financial crisis in 2008, and the same again in London. We've had a really good run in Lisbon, where the market's been really strong. And as well, we're going to be discussing Berlin. So it's about getting into these capital cities at the right time. And that's really one of the things that we've been doing over the years. And we've backed away from a few of these cities. I mean, we don't do anything in Hong Kong now because there just isn't a lot of value there anymore. And that's
we're both based there, and of course we get asked about that a lot, basically, don't we? But fundamentally, the issue we have in the Middle East compared to other places is supply and demand. Mostly everywhere here is severely underpinned by not enough property for the growing populations, and that's for all the other things which are great about the market here. Supply and demand is very much not. So, lesson learned. It's a higher risk factor for us, and capital cities, that's what it represents. Low risk. The most amount of people looking for the best paid jobs in their specific country. And really, wealth preservation and security of that wealth is foremost in our philosophy of how people should invest, and that's why these big capital cities often are our principal focus. Next slide. So yeah, how do we judge that? What does safety mean? And all these things we look at here are essentially a mitigation of risk and looking for safety first. So, as I said, supply and demand, wherever you are in the world, that's the skeleton, the backbone of everything you want a good property investment to be. You want there to be not enough property for the amount of people there. So both on the rental side and the price side, there's more people competing than the available properties, which is the underlying dynamic of what keeps upward pressure on the market, basically. So even in a good market, in bad times, we'll be holding firm, and in good times, we'll be flying, rather than markets fly up and fly down, which we can see in plenty of places in the world. So population growth, obviously these cities need to be popular. They need to have a wide range of jobs and industries there, which are attracting people for, earning their wages over the years, and that outlook for those economies to be strong. So we want industries which are future-proofed to some extent, all the kind of growing industries in the world. So we want a lot of healthcare, tech, sciences, service-led industry, that kind of thing. That's the kind of thing which is a bit more sustainable than some cities which might be, say, solely focused on a certain manufacturing or something like that. So a developed infrastructure, we need these people to be able to move around. It needs to be an easy city for, and a possibility for growth there as well. Political stability, I've been asked quite a few times, let's say, for example, about, Turkey being a good spot, and, a lot of the fundamentals might stack up, but, it's a market which, politically would be one of the last on my list, I suppose, for that kind of thing. So you always have to know what the next 20, 30 years looks like, essentially. You don't want that question mark to be there. So lower investment risk is largely a reflection of a lot of the things we're talking about here. And stable housing markets, a lot of that comes from the supply and demand, but we want a long and stable legal framework. Some of the markets we did pre-GFC, probably wasn't just the case. We probably learned that the hard way. That, say, having our being able to control the developers, being able to have a clear idea of, the buyer and the seller and everyone's legal rights there. And that's exactly what some of these, particularly European older markets, can afford us. And lastly, their culture and lifestyle. You want people to like it. You need people to want there. It needs to have a good reputation. It needs to be somewhere where people want to stay for a decent length of time. Overall, I think that mostly covers it. Anything to add, Will?
Yeah, I think also you've got to remember that capital cities are, the driver for the economy. So, the top wealth of each country is generally in the capital city. It's where most of the financial jobs are. It's the economic strength. And that really is why investors choose to buy property there, because whatever happens, your property is going to be rented and your property is going to need to be lived in, and they're so undersupplied. So, that's why investors are willing to perhaps take a lower yield and a lower return on their investment, because of the security of that. And it's potentially more about, there's two reasons why you buy property. You buy property to make money and receive rental return, but you also buy property to protect your wealth. And I see a lot of investors that do always consistently look to buy in capital cities are very much looking to do the protection of wealth as the first thing they wanted to achieve, and the growth as kind of the second mindset. So that's something that often we see. Next slide, please, Mary Carr. Right, we look at a lot of research into obviously what's going on in the property world. PwC are a big research company. They do a lot of different reports, and every year they release a report about the top European cities for property investment. And we look at this very closely, and it's interesting to see the latest report has London right at the top, because we've been having a close look at London now, and London's been a market that's been a little bit flat since sort of Brexit. The market was fairly stable, but not exciting too many people. There's also been some sort of taxation changes, but now things have sort of stabilized after Brexit, and now kind of COVID, thankfully, seems to be mostly behind us. London seems to be reappearing, and the rental market is very, very strong. And given that there hasn't been much growth in London for the last sort of 6 years, there presents a very interesting opportunity for growth moving forward. So PwC think it's one of the top cities, and we certainly agree. Interesting to see Paris. Berlin is always at the top of this report, or in second or third. I can't remember when it ever dropped below third, Jeremy, in the last sort of 5 or 6 years that I've been reading this.
Probably even for the last 9 years, actually. Yeah, Berlin seems to be always top three. And you're right. I mean, there are some cities which kind of pop in and pop out of this. And Lisbon was up there for, in the top two for a couple of years, probably 3 years ago or so. And that seems to have dropped down to the top 10 at the moment for PwC at the moment. So, I'd say like Amsterdam, Berlin, London, and Paris, they tend to always be around here. And some others kind of like, pop in and pop out depending on the current climate. But, that's it, isn't it? We were looking for these ones which are consistently protecting you and bringing returns, and not ones because of some particular incentive or, like political situation why they might have an opportunity there. We won't talk at length about London today, but I think it's probably worth it. It speaks for itself largely, but I think sometimes even people forget, yes, of course it's more expensive, than other markets, but it's 9 million people. It's 4 times the size of the population of Paris, and 2.5 times the second biggest city in the EU, which is Berlin. So, it's the amount of people who work in the financial sector there is about 500,000 people, which is about the population of Lisbon, in central Lisbon. So, you've got to understand the context of the safety that London will bring in the long term. Those sectors are some of the safest we could possibly be attaching our money to in the long term.
Yeah, I mean, we manage, probably about 2,000 apartments across London, and the vacancy rate, it's basically zero. I mean, literally, it's a tenant moves out, we have a tenant moving in, and our clients that have bought in London with us over the years have made a lot of money. The last project we did there was some time ago, and they've also achieved very good rental return and very secure rental return, even when things have been difficult. Right, what's the next slide, please, Mary Carr? So here we just talk a little bit about some of the sort of up and coming cities that we get asked about. These are the cities we get asked about a lot. You know, I must admit, I'm on the road meeting investors all the time, and Amsterdam always seems to come up. You know, there's a lot of people talking about prices have been rising from quite a low point in the last few years. So it's interesting to see that Amsterdam is definitely of interest. And it is an undersupplied market, so it's certainly interesting. Berlin is the fastest growing city in the whole of Europe. I mean, in terms of capital cities, it is very interesting. You know, when the Berlin Wall came down in '89, you had this sort of mass exodus west of people. You had a period of economic collapse. And then in the sort of early 2000s, you've had a reversal. You know, in the early 2000s, population started to grow and government and jobs are being pushed back east. So the sort of eastern side, the former eastern side of Germany is particularly interesting to us because of this. And in Berlin, because of that economic collapse, there was very little property built during that time in the capital. And there is a huge supply issue. So very interesting city for investment. And we're seeing...
It's like an artificial vacuum, effectively, you know, created in, you know, Germany is the fourth biggest economy in the world, and its capital was suddenly a lot cheaper than it probably should be, from, you know, on a pound for pound basis. And so what we've seen over the last probably 8-9 years is, you know, some really good performance there. But still, if you look at it compared to its sister cities and, you know, and other cities you might be able to compare it to around Europe, you know, that means that it still looks like a really good bet. But, you know, we can talk a bit more about it, but, you know, it's what's going on there now and the speed of the growth, which makes it particularly attractive now.
Yeah, exactly. And Dublin's another one. Dublin, obviously, the financial crisis, GFC, in case you didn't know what I mean, global financial crisis, we always use that term, in 2008, saw Ireland really struggle. And Dublin has bounced back in the last few years and seen a lot of growth in the property market. So that's a very interesting city. It is very difficult to get a mortgage, which sort of we'll come on to in the next slide. But that's one of the reasons why we don't invest there. But certainly from a sort of standpoint of what's been happening there, it's been very interesting. Edinburgh in Scotland, a city we love, a city we've invested in before. We'll come on to that later, but obviously a beautiful city, very historic, very well known, has a big banking sector, and is a city that's on the rise for sure. And then of course Paris, that's obviously one of the big cities in Europe and has seen a lot of growth in recent times. But there are sort of things that perhaps turn you away from Paris. Again, lending's difficult as well. Next slide then, please, Mary Carr. Right, so go on, Jess. Is it you? Is it?
Here really was an opportunity to try and compare them in a bit more metric terms, really. You know, so what makes each market good, and what might be something which we'd want to stick away from, you know, for an investment's sake. So, you know, in terms of capital values for properties, and of course, you know, we can find cities elsewhere which are much cheaper than any of these, but, you know, particularly what we looked here is the prime market of each city. You know, so of course there are cheap properties within those cities as well, but prime's a very good metric of stability, you know, and it's probably one of the more researched areas in each one, so it's probably a cleaner, better number to see where the figures are going. So Amsterdam, you know, it's been done very, very well over the last decade or so. You know, I'd hazard to guess that was probably, you know, somewhere near, you know, half that probably a decade ago, and similarly to Berlin in terms of prime. You know, Dublin has had a big surge up to 9,300, particularly on the back of the tech sector. You know, they've got some favourable tax measures, hence why all the tech sectors moved there for companies. Edinburgh looks cheaper than most major European cities there. I think probably Edinburgh's, you know, criminally underrepresented on the international stage, you know, which is reflected by, you know, not being able to get enough property on our sake. You know, like we'd love to have more, but, you know, developers aren't building enough largely. And then Paris, you know, as you'd expect, you know, 15,600 pound for pound, slightly more expensive one. So, you know, some people look at headline price as one of their major things, and of course, you know, on affordability scale that makes sense. But really, the key word with investment is always going to be value, you know, and what that's going to bring to you long term. So, you know, that partly that is to do with its preservation of its wealth, partly to do with the growth we can expect, and partly to do with the yields. yields, the exact yields we haven't got listed here, but what we've shown here is rental growth for the last year. And many things can dictate that. And I would hazard actually, since even the February to February number we're showing here for the last year, since that, some of these markets might have really propelled forwards, with an inflationary environment at the moment. Quite often we're seeing, particularly in some of our markets, like in Germany and the UK, that we're looking after, these thousands of units that Will's mentioned. Some of the rents have been jumping 10-15% on a year, so it's a very good climate for that around everywhere. But really, to show averages in prime here, these capital cities are showing stability and predictability. They are all increasing over time, which is always something we want to see. Transaction costs, not a lot of agents and so forth are going to talk about that with you a lot, but this is part of your investment. It's something to bear in mind when you're considering where to buy. With the stamp duty in the UK going up, the last few years, that's very much similar to these, particularly if you're living outside the country, you've got that foreign ownership addendum to it. But really what we can see is everything hovers around the 10% mark. A lot of it will depend on the price of your property. Sometimes if it's cheaper, it's slightly less, and so if it's more expensive, it's more. But if we can factor all of it in, with all the acquisition costs, with lawyers and stamp duty, and then the exit cost as well, these are the base figures we can see. So Amsterdam looks pretty good on that regard compared to others. Berlin might look, a bit higher, but as we'll see below, Berlin mitigates that highness with the income tax is practically nothing on the rent that you'd hold it for, and the capital gains would be low. Dublin's fairly decent on the round trip costs. Edinburgh 10%, that'd be similar to the UK. To the rest of England. And Paris, like a lot of Paris kind of stacks up on so many levels, but we'll see here, the tax is a thing which almost in everything kind of brings it down a peg or two, because we've got the higher transaction costs, and we can see there on the tax implications there, you've got 19% plus 17.2 on the social charges for capital gains, which is, bringing it into the 40s, and then income tax, including the social charges, can be from 37 to 47. So great secure market, but we've come back to it and looked at it a few times, and in the end of the day, when we've got a certain amount of money to underwrite projects in safe locations, like going to somewhere like Germany here, which if you hold a property for 10 years is zero capital gains, and with all the deductions they can do in Germany, you're going to be pretty much on zero in terms of income tax as well. Why would we put our money in Paris or in France? Germany just makes that much more sense, particularly considering the growth prospects are looking equal or better than Paris. So these are the kind of things we want to consider. Basically, it's not just how attractive price is and what the market looks like. It's essentially how much the government going to take of those returns in the end as well. So tax is I like to say a necessary evil for these successful property markets. They are safe and successful, but equally for all that profit, and hopefully it's going to be a lot, there will be some taken. So mortgages, the last thing, 90% of our clients like to take a mortgage, and we think for the power of leverage in a good stable market which will grow over time, people largely should take mortgages. You need access, and so we put our feet in the water with Dublin a few years ago. It was incredibly difficult to get expats mortgages unless you have an Irish passport. It was there's literally one bank out there, which is a high risk play. Netherlands, you have to have a Netherlands passport to be able to get mortgages there. So that'd be a shame. We'd love to do it, but frankly, if you can't leverage, we're not going to do it. Berlin and the rest of Germany, incredible mortgages. We can get 5, 10, 15-year fixed rate mortgages. Currently, even now, with the high base rates from the central banks, we can get under 4% locked for 10 years for buyers there, which is bite your hand off territory, really. So that's incredibly attractive when you look at the tax efficiency of it and having a cheap mortgage. It becomes a bit of a no-brainer. And Edinburgh essentially has 99% of all the mortgages available to anyone purchasing into England, which people are very familiar with.
I think it's important to remember that international investment in cities is key, and it does provide stability. So somewhere like Amsterdam just hasn't got the international money coming into the market, and that makes it potentially a little bit more there's less room for growth there because of that ultimately. But I think Jeremy's touched on Germany and Berlin, but non-resident investing in and borrowing into Berlin is there, but it is limited, and it is a sector that we think is going to grow as foreign investment comes into Germany more and more.
And the strategy anyone should have as an investor as well is you look at these prices, and we can see how well they've done, particularly in these prime areas. And that doesn't mean when the prime areas get very expensive that we leave the city alone. We naturally, what we do is we migrate. We go to the areas just slightly out. We look for the next regeneration zone. We want to see public and private money being spent on a large scale. And when prices go up and land values go up in the centre, developers will move further out to follow the people, essentially follow the renters. And so that's what our investment team really focus on, is finding those pockets of value which are just on the outside of these areas, basically, which are then going to be the ones primed for the growth spurts over the next 5 to 10 years, which is sometimes the trickiest thing to do. But that's why you have partners like us.
Yeah, I think, Jeremy, a good point there. Capital cities as well. You've got gentrification in capital cities can happen very quickly. We've seen it in London, we've seen it in East London, we've seen it in sort of in West London as well. And we see it happening in regional cities in the UK and in smaller cities across Germany, but on a smaller scale, and it takes longer to actually have an impact. So I think that's just something to bear in mind, that due to the amount of money that's in these cities, gentrification can happen more quickly, and it's those little pockets of value that you want to be buying in when real estate in sort of prime areas has become extremely expensive. But I come back to, why do investors buy prime Berlin property? Why do they buy prime Edinburgh? Why do they buy prime London, prime Paris? Well, they buy it because they think it's very secure, it's a protection of wealth, and very liquid, very, very liquid as well. You want to sell it, you can sell it like that.
It's always rented.
And it's always rented, exactly.
The next slide.
So what are we up to at the moment? What are we investing in terms of capital cities? You saw a map a few slides ago of the different cities around the world that we've chosen. And Jeremy touched on it, but at the moment we have an opportunity in Edinburgh. We think it's a great city. We just go to the next slide. Here we can see sort of a little bit of a snapshot of the economy. So Edinburgh has a massive financial services sector, obviously smaller than London, but over 37,000 people working in financial services. So that makes it the 7th largest financial service sector in the whole of Europe and 21st worldwide. And I think that's probably sort of forgotten, because in our world and property investment at the moment in the UK, Manchester's a big market. We like it. Birmingham is, and we're always talking and hearing about banking jobs that are being pushed north into these two cities. But still, Edinburgh is some way above them in terms of employment and banking. And I think that's something that people miss. In terms of digital and tech, it's second to London in terms of employment of that sector. So there's a really sort of modern young workforce that are working in this growing sector of economy, which is obviously set to continue to be a big, big part of our futures. Food and drink, tourism, whiskey investment, whiskey production. It's a big economy. A lot of the big players are operating out of Edinburgh. And then, of course, energy, you've got North Sea oil, North Sea gas, and you've also got renewable. And again, Edinburgh sort of plays a major role in employment in that sector as well. So, you've got a fairly small city in terms of sort of population, but you've got a lot of people working and a lot of people earning really good money. And you've got very tight planning laws, and you've got a limited supply of property, ultimately, which is why we're interested in it.
And a big thing going for Edinburgh in that regard is, of course, UK is the country, right? But, Scotland also is a separate country. So when you get big corporates and so forth, who want to have their different head offices in different places, sometimes you have slightly different laws and so forth, and there becomes a need to have a head office in the other country, in Scotland. So actually, Edinburgh ends up being that focus there. So these big name brands, particularly of course, with the energy sector, with the North Sea gas fields and so forth, and that's all going to be centered here. But also then it's got all the renewables, well, not all the renewables, but the large proportion of renewables in the UK. A lot of that's going to be centered around Edinburgh as well. So it's getting, it's not punching above its weight. It's for a city of 600,000 people, the average wealth is far exceeds. There's more money there, more money in big business, more investment going on than a lot of other cities, which might be slightly bigger than it around in the rest of England as well. So that's that reflects for me extra safety going forward.
Next slide, please, Mariko. In terms of population, Jeremy's mentioned how many residents, but you can see that sort of fairly flat for a number of years during the 80s and the early 90s. But, population has really started to grow. Since 2001, that's increased by 19%. And there's a further increase of 7% forecast by 2035. This data is Oxford Economics, which we subscribe to. So, very interesting to see that. And that has put pressure on house pricing, and that further population that's coming to work in this city, earn good money, work in banking, work in tech, is all going to be needing to buy property and rent property. And then you can see the bottom graph there in terms of the size of the economy. I mean, it was worth, in the year 2000, it was worth 10 billion to the British economy, and it's almost 30 billion, just over 30 billion today, and again predicted to be up at over 50 billion come 2035. So there's a lot of growth forecast, and this is what you want to see in a city. You want to see the economy growing, you want to see the population growing, and you want to see people in jobs. And you look at the unemployment rate in Edinburgh, it's currently very low. It's at 3.9%, and it's estimated by Oxford Economics to be coming down to 1.9 by 2035. So that's one of the lowest unemployment rates you'll see across the whole of Europe. Next slide, please. And then the housing market, tight regulation, historic city. They're very protective of Edinburgh, as they should be, because it's such a beautiful place. But there isn't in Edinburgh, and there isn't in a lot of capital cities, there isn't a lot of room left to build more properties. And it's very expensive to build. So, developers are, sites are limited and building is limited. So, you've got a real housing problem in a lot of these cities. And that can be seen here in Edinburgh, where, you've got a deficit. You've got a big deficit of housing, and it's creeping up year on year. And again, over the next sort of 10 years or so, when does that run? 2031, we're expecting that there's still a shortfall of 30,000 units. And my guess, my estimate would be that with rising inflation at the moment and rising build costs, that is going to be a lot higher come then, actually. I think that's probably being optimistic in terms of the supply that we're going to see. Next slide.
So, yeah, I mean, looking at some of the same statistics and things for Berlin as a bit of comparison, then, we mentioned this is a city of 3.7 million people, and some of that history we talked about how, it's a vast change. The city merged again. The poorer side on the east, people migrated away. A lot of people went to Hamburg and Frankfurt, Munich, and now for the last 18, 20 years or so, they've been kind of pouring back in. And so there was an opportunity really to reinvent the city in terms of its, major economies. And so, it's every year eating up a little bit of Frankfurt's financial sector, and, and Munich, and, obviously being the biggest economy on that kind of side. But yeah, energy and technologies, transport and mobility, healthcare, information technology, and media and creative. Like, these are, like we said, like some of the industries which are going to be future-proof to some extent. These are the ones which are on the growth, and the eastern side of Germany in particular, that's where 75% of all the startups in the country are happening, with the main focus of that being Berlin, because it is the capital. A lot of these big companies want to be closer to the center of politics and closer to all this big population of people. So that's why they've been getting there. But also it's been cheaper for them to set up offices and their headquarters here in terms of, the rents for the offices. So what we're seeing then is a dynamic shift in where that market's going, and hence why such good growth prospects. And so, a lot of the big name Tesla, for instance, they've just put their gigafactory just outside of Berlin, on the outskirts in Brandenburg. That won over many global cities which are competing for that, and they're putting their big gigafactory for batteries there as well. So as that dynamic of cars changes, eastern side of Germany is taking up most of that business, basically, because there's land available, which is purchased much cheaper on the west. And so the propagation of the biggest companies that are emerging in that sector is all happening within this region and in and around Berlin. So that kind of thing almost alone would be quite exciting, but all the other things that are marrying with it means that it's a very healthy, dynamic economy looking forward.
Yeah, and I think, Jeremy, it's important to remember that Berlin, has had its difficulties when the wall came down and a lot of its young population and working population sort of left for what they thought would be a better life in the West. But now that they're coming back and the economic growth is coming to Berlin, because it's cheaper to live there, it's cheaper to operate your business and run a business from Berlin than it is in one of the wealthy cities in the West. But you've got a city that it's just incredible. It wasn't really even a free market, before the wall came down. And it now really is. So it's the startup hub of Europe. It's a very young city. There's over 180,000 students in the city living. And previously they would sort of educate themselves and they would leave. And it was known as the poor city. You had this sort of brain drain effect happening in Berlin. And now, actually, interestingly, Berlin offers the highest graduate salary out of any German city. So there's been a complete reversal now, that those young, well-educated Germans and international students are being employed in the capital, and they're staying. And that's why it's one of the youngest and one of the most exciting cities to be living and working in if you're there. Right, next, what have we got next?
So yeah, mirroring the Edinburgh slides, some of this looking at the both population and economic growth that we're seeing there, and kind of usefully then we're looking at comparison for the big 8 German cities we see there. And so population growth since 2000 has been 13%, only bettered by Munich and Frankfurt at that time when they were going through their booms economically. Those two have slowed down a bit now, but what we can see, even and it's a lot harder for a big city to do it, and it's worthwhile seeing there on the left that Berlin is vastly bigger than any other city in Germany, and as I say, the second biggest in Europe. So 3.7 million, expected to have actually the fastest growth over the next 20 years of any German city, rising by another 11% to 4.1 million. This just goes to reflect just how popular it is, for all those economic reasons we were talking about there, but also, a lot of the youth as well really consider Berlin a really super cool place to be, and so that really helps in the long term. And so all these things are driving that sustained population growth, and along them, the bottom here with economic growth, 109% since 2000. So a total city economy of 179 billion euros. But particularly 94% from now to 2040, that's the highest of almost any of the cities we're looking at now for the onward growth cycle. So, sustainability essentially is the word. Whether different things happen, the tides change slightly, brings these things up or down and so forth. All the factors considered, this looks like low risk market essentially with upside potential because of its artificially lower prices than it really has any right to be at the moment. There's a lot of people talking about Berlin as the next global mega city. It might, we were talking about London and New York and so forth in that kind of brand. So it's got a little way to go to that kind of population size, but it's the fastest growing. It's the second biggest in Europe, and the speed of growth of the economy is bringing it to there. So, it's seriously be considered as a global city of super import over the next years.
Yeah, exactly, Jeremy. And in the early 2000s, you didn't have, you had a lot of people leave, but you had a lot of unemployment. Unemployment was almost, I think it was like 19.8% was the peak in the year 2000. You know, that's the capital city of Germany, the powerhouse economy of Europe, with almost 20% of the population, the working population, not well, the possible working population not working. And that's come all the way down now over the last sort of 20 odd years to 5.5% today, and predicted to stay down that low. I mean, predicted by Oxford Economics to be, you know, at around about 5% by 2035. So, you know, that's very interesting. So yeah, obviously we're very excited about values in Berlin. We're just slightly tweaked where we buy because values have risen very centrally. I still think I'd buy in central Berlin if I had the budget, to be honest with you. I still think it would be a very good place to put money, but we are always looking for a little bit more value as prices kind of ripple out from the city centre. So probably compare it to a bit like the sort of London market 10 or 15 years ago. Primed for growth. Next slide.
And then the all-important thing for supply, it's all very well having that, but if they're building tons of houses, then you're not going to see the price growth. So, and it's a massive deficit they're looking at now. I mean, partly this is due to such a speed of population growth that they really can't keep up. But it's quite a rigid system for planning approvals in most of Germany, but particularly in Eastern Germany, when they want a lot of the Eastern Berlin to be regenerated. So they put kind of pressure on developers to work on that and to put money into there. So actually, you know, the amount of properties you would love to have as a company is a lot less than we're even able to get. So, you know, what we've factored here is the highest amount of property that they've delivered in the last 10 years and use that as our baseline. Said, right, if they keep hitting that marker with this population growth, where's the deficit likely to be? So by 2040, you know, we're still likely to have, you know, just shy of 90,000 homes deficit. And this is a graph showing a very optimistic view of what they can achieve. So, you know, unless some kind of massive government drive comes in and spends billions on, you know, building 200,000 new homes, they're going to get nowhere near it. And frankly, there's not the money locally for them to do that, or the land, frankly, for them to do that. So yeah, you know, for us as investors, it's music to our ears. You know, it means that that's stable and sustainable for the future. It means there's going to be locals competing hard on rents and you know, competing hard on the property prices as well.
Next one, Matt.
Yeah.
One more. So we thought hopefully we've given you a bit of an idea about what's happening in capital cities and why we sort of focus at the moment on Edinburgh, and we're going to be hopefully having a look at London and why we've got opportunities in Berlin. But just to start with, we've got a project in Carrick, which is the Carrick in Edinburgh, which is a really good example of the kind of location that we like to invest in Edinburgh. So if you can sort of picture Edinburgh, this is about 2 kilometers west of Central. So it's still very, very much central Edinburgh, really, but there's some real value on offer here. And we saw that prime values were pushing sort of 9,000, you know, per square meter, 9,000 pounds per square meter. You know, you compare that to here, where you're looking at about £4,500 per square meter. So if you're speaking in square feet, think about £450 a square feet. I mean, this is cheaper than buying in central Manchester. Nice development, 27 apartments being built by Mandel Homes that we've done. This is actually our 10th development with them. 1 bedrooms from £237,000, and then two.
Oh, he's just paused for a minute. He'll come back. You paused. You're right. You're back.
You've lost me.
Yeah, you're back.
Where did I get to?
It was about 10 seconds ago. It's fine.
Okay. So yeah, I was just explaining that the site's going to be completing at the end of Q3 next year. Mandel Homes, who are the builder that we've partnered with, they're going to be building it. They're starting work in September. And you know, our view is that this is very good value. It's close to the city centre. It's in a regenerating part of the city centre, and it's set for some good growth. The other nice thing is, with interest rates being a little bit higher than we'd all like them at the moment, for obvious reasons, the fact that this completes sort of towards the end of next year means that we think we'll be on a sort of slightly different interest rate environment, and we'll see interest rates beginning to come down and cheaper lending being released to those looking to borrow.
And what we've seen time and time again, when we go through the property cycle, which we all know about, a lot of time we don't think about it. Right now we're in a really high rental growth period, which partly mitigates obviously the higher rents, the higher mortgage rates that we might be getting at the moment. But what always happens with that is, you might have a proportion of the potential buying population might keep their gunpowder dry for a little while, and then when mortgage rates start to come out, we'll start having a larger flood of people going back into the market essentially. So, we're, the back end of next year and so forth. I mean, certainly, in my opinion, is likely to be a spike in prices as people will flood back into the market essentially. So, in terms of picking up value, before it does rise, I would suggest that was, if you have the affordability to do it now, deals are there, and we've picked up a great deal on this project in terms of its land value and the prices for it, and this is certainly one of the ones which is going to come good. And we see here at the bottom, sales price is expected to grow as an average in Edinburgh 17.6% between 2023 and 2027. So that's a 4-year turnaround expectation here.
Next slide, please, Mary-Carl.
And so, yeah, for Berlin, we have a project, Eve Quarter there. We talked about this kind of migration away from the city centre, and we've done 24 projects in, Germany now, and probably about 3/4 of those being in Berlin, dotted all over the place, and over the years it has got gradually further out. We're in an area called Köpenick here now, which actually is, people are familiar with London. It's, from my mind, it's a bit like Richmond or so. So it's about 20 minutes out on the train, or will be 20 minutes when they've got this extension brought there. It's about 30 minutes at the moment. So a really quick distance in, but it's a very established, a very wealthy area already. But it's one of the biggest areas of growth change at the moment. The searches online for properties, the average rents and the average asking prices are all some of the highest going on in Berlin at the moment. So it's certainly in a hotspot. So we have got this property for hovering around the 7,000 euros a square meter, which we compare that to the prime central, which was almost topping 12,000 there. We really think this is one of the areas which is the most safe in terms of attractiveness to renters, super accessible to the city centre, and positioned perfectly for in between, of course, the city centre with all its jobs there. We've got the Tesla Gigafactory about 15 minutes drive to the east, and about 20 minutes or 15 to 20 minutes, there's the Brandenburg Airport, which is Berlin's first international airport, which is crazy to say, which they opened in the back end of 2019. But before then, you couldn't fly from the Middle East or Asia to the capital of Germany. You had to fly into Frankfurt and Munich and then hop across. So, that in itself is an enormous driver to the economy. So this area of Köpenick is positioned right in between those. And so we think in terms of value and in terms of the growth expectation, that this is about as good as you can find in Berlin. So 1 beds from 325 to 450 here, and 2 beds from 494 to 519. It's part refurbishment, part new build, and the completion here is coming into the is it back into 2024 or early 2025? I forget.
Sorry, Jamie, I was reading the questions. I can't help you with the answer to that. I wasn't listening.
Yeah, no worries. But no, one of the attractive things here, even with a property which is off plan like this, you can get your mortgage organised now, completely locked in. So there's no, organising and figuring out what the mortgage rate is going to be in 2 years' time. Germany's got some of the lowest we could find anywhere in the world. So we get 3.9% or so locked for 10 years. But you can fix that and get that contract, that mortgage sorted now. So even if the property is delivered in 2 years, that's fine because your mortgage is already sorted out. And so they'll have construction milestone payments with these properties in Germany. So there'll be 7 milestones between whenever you purchase and the construction time completion. And so you can drip feed your money in over that time, and the mortgage could also get drawn down over that time. So it's a beautifully secure system, and so you can lock in the price now in a market which we know is going to grow, and lock in the mortgage for it. So everything's kind of ring fenced and sorted from the beginning.
Yeah, and that ties in nicely, Jeremy, with the capital gains tax relief. So if you hold a property for 10 years in Germany, there's no capital gains tax. I mean, we saw that Amsterdam are going to be introducing it. There's no other city in Europe where you won't pay capital gains tax on your profits and you've got to hold for 10 years, obviously. If you don't hold for 10 years, then it's deemed as income and you pay the income tax bracket that you're due to pay on that. The 10 years also starts ticking when you actually buy the title, and that's at the beginning. That's sort of now, even though this project is ready in the early part of 2025. So there's a real benefit there.
Yeah. So yeah, you're 18 months, 2 years into your 10 years by the time the property hands over in the end anyway. And those the interest on the mortgage, if you are drawing it down during construction, can get deferred to completion as well. So you don't have those extra costs during construction. So yeah, I mean, that's, you know, finality of the actual presentation today. Well, you said they were kind of looking at questions. I mean, by all means, if anyone has any questions about the anything being covered today, or anything that's on your mind which we haven't covered today, because of course we do look at lots of other cities as well. You know, today's focus was very much just on the capital cities for kind of that real reason of security and stability. But if you've got other markets either we buy in or that you've been thinking about, I'm quite happy to look at questions on those.
Well, look, Jeremy, there's a good question here that I'll read you. We won't spend too long on questions because I've just realised how long we've been going on for. We said we'd be done in 45 minutes, and it's now 53. So, question: is it difficult to invest in a city where you have no ties? What about language issues? Blah. Yeah, I mean, that's a very good question, Jeremy.
Well, I mean, the short answer is it can be difficult, but you need to be able to find lawyers who can work for you and have letting agents and so forth, and be able to read the contracts. But I mean, that's part of our business essentially. Even if we're working in markets which aren't in English, we will have everything on service effectively. So lawyers and letting agents and everyone will have the ability to conduct all of that in English for you. So 90% of the people I've worked with over the last decade probably don't physically go into the the market and fly to that country and go and see the properties even. This is very much a hands-off asset class, and everything can be conducted in English. So yeah, for something that can be tricky, you do need to be able to read the contracts and understand them, implicitly. So it's all be there in a language you can understand, also with us to support it. But if you were doing things independently, you need to be absolutely clear about what you're getting into.
Yeah, I mean, we did our first investment in Berlin in 2014, so we've been doing it a long time, and we've got a really slick process in terms of how we do the transaction, do the mortgage, and do the rental. We have a joint venture in Berlin. I don't know if you've lost me. My signal's dropped again, I think.
No, yeah.
Any plans for Cardiff if we can't afford London? From Rachel. I mean, yes, London is extremely expensive. We definitely do sympathize with that. Not Cardiff. We've got our eyes on, and we're always looking for opportunities in Birmingham, Manchester. We have a development in Sheffield at the moment, which offers extremely good value. We've obviously got Edinburgh. So those are the sort of cities we're focused on at the moment, just because the economies there are far stronger, and the rentability and the long-term growth prospects are, in our view, would be slightly stronger than Cardiff.
Yeah, and I think
one more question, Jeremy: is it best to invest outside the UK due to interest rates at the moment? I think interest rates is very topical. Rates, in our view, are very close to the peak. We've already seen inflation dropping, so we do think that lending is going to get cheaper. If you don't like the rates where they are now, you want to look for something with a decent build time. In Germany, we've still got very attractive. So there's sort of a different answer to that question.
Base rates across the board because they need to drive inflation down. So as ugly and painful as it is in the short term, it's for everyone's best. Everyone's good in the long term. Basically, they need to be more aggressive now to make sure those inflation rates drop quicker. And we can see in in Europe and the US and the UK it's working. The latest rates came out 6.8% inflation in the UK earlier this week, and and everyone's getting more and more positive about that. So you're right. I think we are likely to be even close to the peak of the base rates. But when you're going to buy a property and you're looking at a relatively unattractive mortgage rate now, this is very much a short-term thing. That's not going to be your rate for the 10 years, 15 years you hold the property. That's now at the time when we are wrestling down the higher rates of inflation. So actually, in a couple of years, the general consensus is that base rates will be dropping considerably by then, and your mortgage will be dropping, and the product you initially picked, you'll be changing to something new, and you can take advantage of the cheaper rate for the rest of the duration. But whilst rents are so sky high and have been going up, you're for a lot of it mitigating any rises you're seeing there from the extra rent. And property is a long-term game. So I think before we see prices surge up again, because we're dealing in these capital markets and capital cities, these are the markets which are going to be holding value extremely well and won't be dropping. Before we see those price surges again, even if the mortgage looks expensive now, it still makes absolute sense to get that good price per square foot on the good areas.
Yeah, exactly. It's become a buyer's market now, and we're a buyer, and we're very actively looking for opportunities. So it's a good time to have cash buying. And long term, the fundamentals are there, supply and demand. Good. Well, look, we'll wrap up there. Thank you, everybody, for joining us. We hope you found it useful. If you've got any questions, let us know. Reach out to your consultant who you know, or drop us an email. And hopefully we'll see you in 2 weeks when we'll be discussing the rental market in the UK.
Thank you very much, everyone.